If you've paid off your credit card consistently, but your score drops anyways, you might be focusing on the wrong thing. And that mistake can cost you thousands of dollars anytime you take out a loan. Like if you finance this car over 5 years with an 800 credit score, you would pay $4,200 in interest. But if you had a 650 credit score, you would pay almost $9,000 in interest. So here are the actionable steps you can take to get to 800 in the order that gets you there the fastest. The first thing you need to do before anything else is understand exactly where your score stands right now. Because while your credit score is one number, it's built from 5 completely separate calculations and each one is weighted differently. These are payment history, credit utilization, length of credit history, credit mix, and new credit. Every one of these factors can be sitting at excellent while another is sitting at poor, and the overall score you see just blends them all together. So before you do anything else, you need to check each one individually. But how do you check this without hurting your score? Well, your bank or credit card probably has a monitoring tool in their app that breaks down your score by each factor. And if yours doesn't, Credit Karma does this for free. So if you've come across services that charge a monthly fee to manage this for you, you don't need them. Checking through any of those tools is called a soft pull, which means it has absolutely no impact on your score. The check that temporarily lowers your score is a hard pull, but we'll get more into that later. Once you can see each factor, sort all 5 into 2 groups by rating. Now put every excellent to good rating on one side and put every fair to poor rating on the other. In order to get an 800 credit score, you have to work on all of them, but anything in the fair or poor group gets your full attention first. And if multiple factors are sitting in the poor category, then prioritize them by weight. So let's go in order. The heaviest factor on the list is your payment history. If your score is already decent, then payment history is the first factor you assume is already handled. But payment history isn't just your credit card. Every loan you carry is recorded on your credit report, so a missed payment on a student loan or a car loan counts exactly the same. This factor makes up 35% of your score, and it covers more accounts than you're probably tracking. But what you don't expect is how much a single missed payment can actually hurt your score. According to FICO, one missed payment can drop an 800 credit score by anywhere from 90 to 110 points. And that mark stays on your report for 7 years. But the good news on this factor is that your credit report only tracks whether you paid on time, not by how much. The minimum payment counts as on time, so in a tight month where you can't clear the full balance, making at least the minimum payment on every account still protects this factor. So pull your full credit report online for free and go through every account. If there's a missed payment on there that isn't accurate, you can actually dispute it directly. Reporting agencies are legally required to investigate within 30 days. Second, if you can, use a credit card that's linked to the same bank account as your checking account. When your spending and your balance are in the same app, you can see in real time whether you actually have the money before you charge something, and that removes the main reason people accidentally overspend. And third, pay your balance every week rather than waiting for the due date. Pick any day of the week, like Sunday, and clear whatever is sitting on the card. Because of the 21-day grace period between your statement close date and your payment due date, you physically cannot make a late payment paying off your card every week. And just for peace of mind, set up autopay for the minimum payment on every account you have. It won't lower your score and it costs nothing, so there's no reason not to set it up. The next largest factor is your credit utilization, and this can be fixed today. Utilization is the percentage of your available credit you're carrying as a balance at any given time. Like if your limit is $1,000 and your balance is $300, that's a 30% utilization ratio. It's a simple calculation, but it makes up 30% of your score, which makes it the second biggest factor on the list. Once a month on your statement close date, your card issuer reports your current balance to Equifax, Experian, and TransUnion. And that reported balance is what gets used to calculate your ratio. Your due date, the date by which you need to pay to avoid a late fee, comes after the close date. So if you're carrying a $900 balance on a $1,000 limit all month and pay it off in full 21 days later on the due date, you've avoided the late fee. But those three agencies already saw the $900. And from their perspective, you were at 90% utilization that entire month. And the utilization breakdown looks like this. 0 to 9% is excellent, 10 to 30% is good, 31 to 60% is fair, and above 60% is poor. So find your statement close date in your credit card app or any past statement and try to pay your balance down the day before that date every month. I've historically kept my utilization under 3%, and while that puts me in the excellent range, it's actually a sign I'm being a little too careful with my finances. According to Experian, the average person who has already reached an 800 credit score carries a utilization of around 7%. Sitting at 3% doesn't add anything to your score compared to sitting at 7%, so if you're in the same position, anywhere under 10% gets the job done. The second move takes about 5 minutes. Call your card issuer and just ask for a credit limit increase. If your balance is $200 and your limit is $2,000, that's a 10% utilization. But if your limit goes up to $4,000, that same $200 balance is now only 5%. Your spending hasn't changed, your spending ratio has, and that can almost immediately boost your score. While utilization is the fastest mover on this list, the next factor is the slowest, but there are a couple steps you can take to speed it up. Out of all 5 factors, length of credit history is the one that catches most people by surprise because there are actually 2 separate sub-factors inside of it. And a move that improves one of them can cut the other in half without you realizing it. The age of your oldest account and the average age of all of your accounts combined. Take 2 people. Both are 30 years old, both opened up their first credit card at 20, so they have the same oldest account and the same 10 years of history. Person B decides to open up a second card to raise their credit limit, which is actually a smart utilization move. But the moment that new card opens, person B's average account age drops from 10 years to 5. Their oldest account didn't change at all, but their average age just got cut in half. This is why length of history rewards patience over activity. Because the longer your accounts have been open, the more evidence a lender has that you can manage debt responsibly over a long period of time. So if I were you, I would open up a credit card as soon as you can, as long as you're responsible with it, even if you have no plans to spend on it. And instead of closing an older card because you stopped using it, find one subscription you're already paying for every month, put it on that card, and mark the charge date on your calendar so you can pay it off the same day it hits. Now with payment history and utilization covered, the last 2 factors each carry 10% of your score. Credit mix is by far the most confusing category because it's kind of counterintuitive. It measures whether you have both revolving accounts, which are credit cards, and loans with fixed monthly payments like a student loan or a car payment. The idea from a lender's perspective is that someone who has managed both types have a broader track record than someone who has only ever managed one. But the wrong move here is taking out a loan you don't actually need just to move a factor that's only worth 10% of your score. The math just doesn't justify it because of the next factor. But for now, the one move that's actually worth considering is if you don't have a strong history on both sides, then use the authorized user trick. If you have a parent or family member who has proven to be good with credit cards for a long time, you can ask them to add you as an authorized user on their account. You don't even need to use the card, and their account history gets added to your credit report, their years of on-time payments, their account age, their credit limit, basically everything. This works in both directions though, so if that person carries a high balance, misses monthly payments, or closes the account, your score is going to move with theirs. So before being added to any card, check their credit score with them first. You're looking for something above 760 with a long, clean history, and anything below that just isn't worth the risk. And this last factor is the one where actively trying to improve your score can end up actually lowering it. A lot of people don't realize this has happened until they check the report and see an inquiry they don't remember authorizing. Every time you apply for a new line of credit, whether that's a credit card, a car loan, or a mortgage, the lender pulls your credit report. That's called a hard inquiry, and it temporarily lowers your score. Now, one inquiry by itself doesn't move things much, but several in a short window signals to lenders that you're actively seeking out a lot of new credit, which looks on paper like financial disaster, even if that's not the case. Hard inquiries stay on your report for 2 years, but their actual scoring impact is mostly gone by 12 months. If you're planning a major purchase that requires financing, don't open up any new lines of credit in the months leading up to it. An inquiry right before you apply for a car loan or a mortgage drops your score by the time your lender is actually looking at it. Now that your utilization is coming down and your payment history is clean, you're not just going to start qualifying for lower interest rates on future loans, you're also going to qualify for lower rates on your car insurance. I go more into how much car you can actually afford based on your own specific situation, like your credit score, in my last video, which you can check out here. But before you do that, make sure to like and subscribe. Thank you, my friends, for watching, and I will see you next time.